Hello, everyone, and happy Financially Lit Tuesday! Thank you for joining me every Tuesday back at 6:30 p.m., bringing you news, tips, and tricks on how to wealth up. Thank you, everyone, for joining me for another episode of Financially Lit Tuesdays. Tonight, we are talking about tax implications on cryptocurrency. So, a lot of people are getting into cryptocurrency trading. Like blockchain and virtual currency is literally here. It's not even the future of the world. It's like the future of now. So really making sure that you know the tax implications of it as you're, getting exposed to it, maybe even learning a little bit more about it is very important. For those of you tuned in, go ahead and drop a comment in the comment section so I know who's tuned in with me. Be like, hey girl, whatever the case may be. And then for those of you tuned in, go ahead and subscribe to the Sipping Wealth YouTube channel so that you don't miss any Financially Lit Tuesdays, and then you continue to tune in. Also, be sure to hit the share button so that all your friends and family could go ahead and wealth up with us, because we don't want to keep this wealthy knowledge for ourselves. Boo, tomato, tomato, tomato. Hey, Brian. Hey, how's it going? Hey. Yes, we in here. Awesome. All right. I know y'all like eager to go ahead and get started, so let's go ahead and do it. All right. So like I said, today we're going to take a look at virtual currency, understanding the tax implications of cryptocurrency, and where does that fall. If you are already trading, maybe you got some Bitcoin, Dogecoin, what was the other one, Shiba, whatever the case may be. Maybe you own a couple of coins and you don't really know how that affects you. Make sure that you continue to tune in. All right, so if you're new to cryptocurrency and the IRS's definition, it's basically, it is a digital representation of value that functions as a medium of exchange, a unit of account, or a store value. Basically saying it's a way of exchanging goods for another item. So this item in particular is virtual currency. So we normally use our fiat dollars. So the cash and things like that we have, that's normally what we use. We use fiat money. But with virtual currency, which is also cryptocurrency, this is how it is defined by the IRS. So it operates just like, for the most part, for those that actually allow it, it operates like real currency. So the U.S. doesn't have a legal tender status, but it operates generally like regular currency. With crypto is a virtual currency that utilizes cryptography, right? So it uses that to validate the actual transaction, and it uses that to also secure the transaction, but it's in a digital form. And it's distributed through a ledger that's like a blockchain, something called a blockchain. All right, y'all. Right. So virtual currency that has equivalent to actual money is called convertible. It's convertible. Right. So that's the virtual currency that people, that you can go on, say, a Robinhood, and use your actual money and purchase cryptocurrency, or even sell cryptocurrency and get real money, right? Convertible money, right? All right. So Bitcoin is one example of convertible. Is an example of a convertible virtual currency, right? So Bitcoin is literally probably the most common virtual currency out here. So Bitcoin can be traded digitally through like users. It could be purchased or exchanged into US dollars, euros, or anyone that allows it. The IRS also published verbiage on like the taxation of cryptocurrency in the notice 2014 to 2021 IRS virtual currency guidance. So for those of you that want to geek out on this stuff, it is in the IRS virtual currency guidance in that notice. All right. So crypto is treated like capital assets. So for those of you that are like, what is the capital asset? It can work as the same thing like stocks, bonds. So it works as that for for tax purposes. So you treat it as property for tax purposes. So like I said, those stocks, bonds, you're actually being taxed on the gains or the loss from the sale or the exchange of the asset. In this case, virtual currency, crypto. Right. So what essentially happens is you go and you purchase, you use your real money, you purchase this virtual currency. Now your virtual currency is now worth the same amount as the real money that you exchange it for, but maybe it accumulated in value, increased in value, and you purchase something else with that virtual currency. Now you are actually being taxed on the gains from the exchange of goods. All right. So capital assets are taxed whenever they are sold at a profit. When you purchase goods or services with crypto, the amount of crypto that you spend has gained and gained in value. That's where your actual tax at. If you're actually looking at a loss, if you sell at less than you actually bought it for. All right. So example, let's put it in like regular terminology, so yeah, you can understand. Okay. So let's say that that's off the screen. So let's say that you bought $50 worth of Bitcoin and you held it, and then it went up to $500. Your Bitcoin is $500, and you're like, you know what? I'm gonna go buy a TV with my Bitcoin. I'm lit. Hey. Now you're actually taxed on the $450 extra that you spent on the TV because you just realized those gains once you purchased the TV. So before, when it was just in your account, brokerage account, it was not yet realized. But when you actually went and purchased the TV, that is realizable capital gains. And that's when you are taxed. So it feels like you're spending Bitcoin like real dollars. Because you are, but you also are taxed on the increase in valuation of the virtual currency. All right, y'all. So taxes are owed when you buy, sell, or dispose of the cryptocurrency. So that's when you call it realized gain. When you realize a gain. So if you don't buy, sell, or dispose of it, and you just leave it there, and it's like accumulated in value, then you haven't actually realized a gain. Now, like I said, again, to repeat myself, if you buy, sell, or dispose of the cryptocurrency, that's when you're actually realizing a gain. All right, y'all. So another example. All right. So let's say that you don't purchase anything, but you buy $2,000 of crypto and you sell it for $2,700. Now you have to report that $700 in profits on your taxes because that's your realized gains. Now, if you dispose of the cryptocurrency and realize a loss, you can deduct it on your taxes up to $3,000, y'all. So capital losses can be deducted up to $3,000 for capital losses. All right. And that's, current nowadays. Let's, and the future may change, depending on the tax laws at that time. Buying and holding crypto itself is not a taxable event. Like I said, if you just leave it in the brokerage account and you just kind of just leave it there and it's like going up and down and it's doing its own thing, then that's not a taxable event. All right. So the following cryptocurrencies, like I'm going to say, all right, can be taxed. All right. Pay attention here. Okay. So this is exchanging cryptocurrency for another cryptocurrency. All right. Mining cryptocurrency, paying for goods or services with cryptocurrency, hard forks or split chains, all right, donating cryptocurrency, and decentralized finance, which is DeFi, all right. So these are taxable transactions. So so the bank or brokerage, they normally give you a 1099 to report the income or the that you have actually received during the year when these events actually happen when it comes to cryptocurrency. All right. Now let's say that maybe you are a Bitcoin miner, you're self-employed, right? This is your job. You mine Bitcoin. Now, this is a whole nother ballgame because you are now employed. You are now self-employed. Now you have to pay the taxes on the money that you're earning through mining, and you have to pay self-employment tax because now you're a Bitcoin miner. This is your job. You know, so you're self-employed as a Bitcoin miner. So you do have to pay those self-employment tax and the income tax on these monies. Now, let's say if you're an employee and your employer is actually paying you in, say, Bitcoin, you actually have to report these earnings to the employee and the employer. They both have to report it on a W-2 to the IRS. So regardless if it's you're self-employed mining Bitcoin on your own or cryptocurrency on your own, or if you're receiving cryptocurrency as compensation for being an employee, or maybe a 1099 agent, um, or you have to show the income that you're receiving and pay those taxes on that. All right, y'all. So that is a really a great overview of how cryptocurrency affects you when it comes to taxation. For those of you that are like, oh my gosh, I just hopped in, whatever the case may be, maybe you missed it. You can always catch the replay on the Sipping Wealth YouTube channel. So be sure to head over there, hit the subscribe button, share this information with your friends and family because a lot of people out here are getting into cryptocurrency. And it's really the future of how we're going to really be exchanging for goods, right? So making sure that we understand how this affects us. Why not understand it now than later and then be confused, right? So be sure to hit the share button, share with your friends and family, y'all. Thank you again for joining me again for another episode of Financial Lit Tuesday. And I'll see y'all next Tuesday. All right, y'all.